Hey there, welcome to the most chill lemonade stand around. Join the happiest club in town and let's make some lemonade magic together. Simply sign up right here at our stand and subscribe. Have you signed up yet? Today, let's plunge into the wild world of money and bonds. Nope, not James Bond, though that would be pretty slick, wouldn't it? I'm referring to something called a 30-year bond auction. Imagine you're running a lemonade stand, and you need cash to buy lemons and sugar. So, you turn to your pals, asking if they can front you some money now, promising to reimburse them later with a bonus lemonade as a token of gratitude. A bond operates somewhat similarly. A 30-year bond implies that the government is seeking folks to loan them money for a lengthy period, 30 years. In return, the government pledges to repay them with extra cash, known as interest, annually until the 30 years elapse. Picture the government as a super planner. They require funds to construct major projects like highways, schools, and hospitals. These endeavors necessitate extensive planning and financing. 30 years is ideal as it grants them ample time to borrow and reimburse the funds gradually without haste. It's akin to borrowing your buddy's favorite comic for a year to ensure you have ample time to peruse it and return it unblemished. But why not 25 or 35 years? It's all about equilibrium. 30 years hits the sweet spot. It offers sufficient time to employ the funds judiciously and repay them. Opting for a shorter duration would necessitate quicker repayment, which can be challenging. Conversely, a significantly longer term might dissuade those seeking swifter returns. Additionally, 30 years is a familiar timeframe, comfortable for many investors and individuals. It feels just right, like a perfectly toasted marshmallow. But wait, there's more. When the government seeks to borrow, they conduct an auction. Visualize a bustling auction where individuals bid on coveted items. However, instead of vying for a mammoth teddy bear or a skateboard, they're vying to lend their funds to the government. The bidders offering the lowest interest rates, remember, that's the additional cash the government repays, emerge victorious. It's akin to a competition to ascertain who's willing to lend money for the least amount of extra lemonade. By soliciting bids on desired interest rates, they can opt for the lowest rate, trimming interest payments over time. This enables them to borrow efficiently and at minimal cost. Who are these bidders? Are they you and I? Not typically. The individuals bidding on government bonds are primarily major financial institutions such as banks, investment firms, and occasionally affluent individuals. These bidders possess substantial funds and seek secure investment avenues. While you and I don't typically bid directly, our savings in banks or investments could contribute to the funds utilized to purchase these bonds. Curious about the bidding threshold? To partake in government bond auctions, substantial funds are generally requisite. Bids often commence at substantial sums, usually starting at $1,000 or more. Nonetheless, direct bidding isn't imperative. Government bonds can be procured through banks or investment firms with more modest amounts, sometimes as low as $100. This ensures that ordinary individuals can still invest in government bonds sans direct auction involvement. So, who conceptualized this brilliant notion? The concept of government bond auctions boasts a rich history dating back centuries. It originated in the 17th century when governments necessitated reliable avenues to borrow funds for wars, infrastructure endeavors, and other expenses. The Dutch Republic pioneered this method in the early 1600s, and its success prompted other nations, including England, to follow suit. The contemporary system of regular bond auctions was honed over time, particularly in the 20th century, to enhance efficiency and transparency. While it's challenging to attribute the idea to a solitary individual, it evolved gradually through the endeavors of diverse governments seeking efficient fundraising methods. Did we say every 30 years? Not precisely. The government doesn't wait 30 years to conduct these auctions. They hold bond auctions regularly, sometimes monthly. An array of bonds with varying repayment durations, such as 1-year, 5-year, 10-year, and 30-year bonds, are auctioned off. Thus, while a 30-year bond spans 3 decades, the auctions transpire much more frequently to ensure operational smoothness. Naturally, we'll decipher the enigmatic codes. For instance, what does 4.64, 2.4 denote? It may resemble a clandestine communique, but it denotes something specific in the bond realm. The figure 4.64 alludes to the bond's interest rate or yield. This signifies that by lending money to the government, you'd earn a 4.64% interest annually. 2.4 pertains to the bid-to-cover ratio. This metric gauges interest in the bond auction. A ratio of 2.4 implies that for each available bond, there were 2.4 bids. Hence, if the government aimed to vend one bond, they received 2.4 bids for it. This underscores robust demand and may indicate the bond's popularity. Consequently, if 2.4 denotes the bid-to-cover ratio, it suggests a fiercely competitive auction, with over twice as many bids as available bonds. This bodes well for the government, signaling heightened interest in loaning them funds. Now, how does this tantalizing intel impact forex traders? Here's the scoop. When a government bond auction boasts a robust bid-to-cover ratio, it signals heightened investor interest in those bonds. This reflects confidence in the nation's economy. With more investors eyeing those bonds, there's an increased demand for the country's currency to procure them. For instance, if the U.S. experiences a high bid-to-cover ratio in its bond auction, more individuals will necessitate U.S. dollars to acquire those bonds. This uptick in demand can fortify the U.S. dollar vis-a-vis other currencies. Forex traders monitor these auctions closely as they provide insights into currency trends. A fervent demand for a country's bonds may portend currency appreciation, guiding traders in their currency transactions. Hence, bond auctions and their outcomes, like the bid-to-cover ratio, furnish vital clues for forex traders, interlinking various facets of the financial domain. These auctions typically transpire electronically, facilitated by government or central bank systems. Investors submit bids online or via financial institutions like banks and investment firms. The government evaluates all bids, accepting those with the lowest interest rates until they've secured the requisite funds. It's akin to an online shopping spree for bonds, where investors channel funds toward the government instead of splurging on clothes or toys. Even though there isn't a tangible marketplace where the auction unfolds, it remains a pivotal component of the financial system, facilitating the exchange of billions of dollars daily. Now, let's delve into the pros and cons of a 30-year bond auction. What are the 4 major pros? Long-term financing. The issuance of 30-year bonds furnishes governments with extended financing for critical projects like infrastructure development, education, and healthcare. This empowers them to sustain initiatives demanding substantial investments over prolonged periods. Lower interest rates. 30-year bonds often allure investors seeking enduring, stable returns. Consequently, governments can usually secure lower interest rates on these bonds compared to shorter-term alternatives, thereby curbing borrowing expenses over time. Investor confidence. A successful 30-year bond auction can signify investor faith in the government's adeptness at managing its debt and fiscal obligations. Robust demand for these bonds mirrors confidence in the nation's economic stability and future trajectory. Portfolio diversification. For investors, 30-year bonds present an avenue for portfolio diversification. They serve as a long-term asset with predictable returns, potentially mitigating the volatility associated with other investments like stocks or shorter-term bonds. 4 major cons? Interest rate risk. While long-term bonds promise steady returns, they remain susceptible to fluctuations in interest rates. If rates ascend subsequent to bond issuance, the value of existing bonds may dwindle, leading to potential losses for investors. Inflation risk. Over the span of 30 years, inflation can erode the purchasing power of fixed-income investments such as bonds. Consequently, investors may find that bond returns fail to keep pace with inflation, resulting in diminished real returns over time. Liquidity concerns. Long-term bonds may exhibit reduced liquidity compared to their shorter-term counterparts, rendering them potentially more arduous to sell in the secondary market. Investors seeking premature access to their funds may encounter liquidity constraints or may need to sell bonds at a discount. Opportunity cost. Allocating funds to 30-year bonds entails locking up capital for protracted durations, potentially curbing opportunities to invest in assets with superior returns or enhanced growth prospects. This opportunity cost is a pertinent consideration for both governments and investors. In summary, a 30-year bond auction entails the government orchestrating a contest to solicit individuals willing to lend funds for 30 years in exchange for incremental returns annually. This mechanism facilitates financing for vital undertakings like infrastructure development, educational initiatives, and conceivably, super-secret spy gadgets. Now that you're privy to the workings of the 30-year bond auction, stay inquisitive, stay venturesome, and don't forget to subscribe for our next escapade.